Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing, or at least reanalyzing, the company Walmart. Now obviously it has been several weeks since I have analyzed this company, and their earnings were actually today before the market opened. So now that the earnings have come out, I want to see where the stock price currently is in comparison to their fundamentals, and using the new discounted free cash flow calculator that I have made, which includes now projected share buybacks, I want to see if I can come up with a fair value for this company and compare that to the current share price to see if it is a worth buy right now. So with that said, let's get started with this analysis. Starting off, guys, we got the dividend summary. Walmart, no surprise to no one, huge major company, probably the biggest retailer in the United States, provides a dividend. And as you can see right here, their dividend yield is around 1.65%, which ends up being around 55 cents a share for an annual payout of $2.20. Payout ratio is around 34.71%, which this is normally what people look at. However, I'm going to take a look at the payout ratio in regards to the free cash flow to make it even more accurate analysis, because companies use their cash flow, not their net income, to pay their dividends. The 5-year growth rate on this dividend is around 2.07%, which is very small for such a big company. However, they have continued to increase it for 48 consecutive years, which is actually really good, which tells me that they're going to continue increasing it into the future, especially since they are 2 years away from becoming a dividend king. Ex-dividend date was December 9th, payout date was January 3rd, and they pay their dividends quarterly. Now coming over here to the spreadsheet, we got the ticker symbol WMT, market cap of $385 billion with a PE of around 48.62. Now, the PE is telling me that this company is very expensive at the current share price of $138. However, the PE is only one metric. It's only taking the current price and comparing that to their earnings. We're going to take a look at all the other metrics: net income, free cash flow, revenue, shares outstanding, total assets and liabilities, and cash on hand, to make an even more accurate representation to what the value of this company should be. And as we saw, they do pay a dividend of $2.20, which actually ends up being $6 billion being paid out in dividends every single year. And once this dividend is actually paid off, they're still left with $13.3 billion in their 5-year average free cash flow, which actually ends up being 31.47% in payout ratio in regards to the free cash flow. So the fact that they are still left with $13.3 billion, guys, pretty much just tells me that this company, Walmart, of course, this is to no one's surprise, is able to 100% afford this dividend. And not only that, they're still left with a bunch of free cash flow left after doing so. Now let's take a look at the fundamentals. Starting off with the net income 5 years ago of $13.6 billion to 1 year ago of $13.5 billion. Now that is a little bit of a decrease of 1%. Essentially, they went nowhere within 5 years. In fact, they pretty much went down from 4 to 3 years ago, and then 2 years ago they skyrocketed. I wonder why. COVID numbers. And then this year they're slightly going down. So I don't necessarily know where this is going with their net income, but when it comes to this specific metric, they aren't really growing. In fact, they're actually slightly going down. Now let's take a look at the free cash flow, which this is the lifeblood of the company. The way that this is calculated is you take the cash flow operations and you subtract the capital expenditures, or add, since capital expenditures are already negative. And in doing so, you get the free cash flow. 5 years ago of $21 billion to 1 year ago of $25.8 billion, which is an increase of around 23%, with an average 5-year free cash flow of $19.4 billion. Now, even though this is an increase of 23%, guys, take a look at this. From 5 years ago all the way up to 2 years ago, they were going down, and then just last year is when they started going back up again. Therefore, I don't necessarily know if you consider this a positive metric or not. Even though the trend line is slightly going up and we are seeing an increase of 23%, the overall scale of this pretty much is telling me that they are essentially flat, because this 23% is only comparing 1 year ago to 5 years ago. It's not taking any of this into account. But in my personal opinion, the way that I see this, free cash flow is essentially flat across the board. Now let's actually take a look at the revenue. 5 years ago of $485.8 billion to 1 year ago of $559.2 billion, which is an increase of around 15.08%. unlike the other two metrics, we actually see a very steady increase in their revenue year over year. Now coming over here to this new metric that when we analyzed Walmart the first time, we didn't have this. I recently just added this, and this is the total assets minus the total liabilities. This is pretty much telling you that if the company were to liquidate all of their assets, would they be able to cover their liabilities, which includes their debt? And honestly, guys, I just saw this like right now, and I honestly had to do like a double take because I could just not believe what I am seeing right now. I honestly had to stop the video, pause it for a second, make sure the numbers were correct, and yes, they are 100% correct, which is, again, really surprising. And the reason is because, well, currently, guys, Walmart, one of the biggest retail companies in the United States, if not probably the world, has negative total assets minus liabilities, currently at $4.7 billion. And not only that, guys, they have been negative throughout the whole entire 5 years, including this current year, which is just crazy. I was not expecting this. I am in shock from this. I cannot believe that this is actually happening. This is really bad because if things were to hit the fan, Walmart could probably not survive. Now, that is a huge exaggeration. Obviously, it's Walmart. I think that they will survive. However, numbers don't lie. They do not have enough assets to cover their liabilities, i.e. their debt, which is really bad to see that, well, if things were to really hit the fan and they would not get a bailout, they would not be able to survive, people stop spending money on them, they would technically, by these numbers, would go under, which is, again, really surprising for a company like Walmart. The total average assets, it's around $69 billion. Total average liabilities is a whopping $80 billion. And then doing the total average assets minus the total average liabilities, we get negative $11 billion, which is, again, really surprising. I was not expecting this. It's a really negative metric. And honestly, I was kind of halfway with the flat income, flat cash flow, and positive revenue. Seeing this just pretty much turned me off to this company so far. But let's actually continue with this analysis and see what we got with the shares outstanding. And, well, looking at the shares outstanding, this is actually pretty good. They have been buying back shares, which is really good to see in a company because buying back shares gives you a bigger piece of the company. They're not diluting you. 5 years ago of 3 billion shares to today of 2.8 billion shares, which is a decrease on the 5 year of 8.86%. And from the previous to the current year, they have bought around 1.5% in their shares. This is really good. But now my question is this. They're left with $13 billion left in their free cash flow. They're clearly buying back shares. They're clearly paying out a dividend. What else is this cash flow going for? Because they're not buying back the shares at a fast enough pace to justify $13 billion. And we know how much they pay out in dividends. So are they reinvesting in themselves? And if they are not reinvesting in themselves, why are they not trying to lower down this debt that they have, as we just saw with the assets minus the liabilities? I have no idea what's going on here, guys. This is absolutely crazy. I was not expecting this. Now, lastly, let's take a look at their cash and equivalents, and currently they have $16 billion in cash and equivalents, with an average cash and equivalents of around $10.8 billion. Now let's make some assumptions, guys. Let's make a low, median, and high assumption, and I'm going to make 3 different factors: growth assumption, projected share buyback, and required rate of return. The required rate of return, I'm going to keep it all across the board at 10% to match the market, and I'm just going to change the growth and projected share buyback of this company. Now, for the growth, I'm going to use the same growth as I did in my last video of 2, 4, and 6% accordingly for each assumption. So, I'm only going to be changing the projected share buyback in response to that previous video. So, for the low assumption, I'm going to assume a growth of 2% with a projected share buyback of 3%. This comes out to being around $119.40. For the immediate assumption, a growth of around 4%, and projected share buyback of 6%, this comes out to be $140.74. And for the high assumption, a growth of 6% with a projected share buyback of 9%, this comes out to be $166.22. Now we need to adjust for debt, and in doing so, for the low assumption, we get a target share price of $102.69. For the median assumption, we get $122.38, and for the high assumption, we get $145.98. Now adding a margin of safety of 5, 10, and 50%, mainly because you want to have a cushion for when investing. The more you pay for something today, the less returns you're going to have in the future. So the less you pay for something today, the more you're going to have in the future. And in doing so, for the low assumption, we would like to buy between $87 and $97. For the median assumption, we would like to buy between $104 and $116. And for the high assumption, we would like to buy between $124 and $138. Guys, the current share price is $138. So, looking at these numbers right here, we are essentially in between the median and high assumption, whether you're looking at the target share price not adjusting for debt or the target share price adjusting for debt. Therefore, it really is up to you when it comes to making this type of decision. Now, obviously, as I just said, it's your decision. These are just my assumptions. You should not believe me. I'm not telling you what to buy. I'm not saying that these numbers are correct. In fact, I highly suggest you get this calculator. I have it available for free for everybody. If you want to have it, just go to the discounted free cash flow calculator video, the updated one, and you get this calculator, and that way you can make your own assumptions. Because at the end of the day, every investment is a present value of all future cash flow. I'm not going to tell you what to buy. I'm not going to tell you where to put your money. All I'm saying is these are just my assumptions. If you do not agree with them, then I suggest you make your own assumptions. So that way, maybe this actually falls better into the current share price as opposed to mine. All in all, when it comes to Walmart, honestly, really big company. I thought I was going to like it because they do pay a pretty good dividend and the fact that they actually can afford this dividend. However, seeing that assets minus liabilities really did punch me in the gut right there because I was not expecting it. So this is one of those cases that, yes, they do pay a dividend, pretty good one too. They are able to afford it. However, this is a huge risk, at least when it comes to me. They have flat income, flat cash flow, revenue is increasing. They have negative assets minus liabilities, so they cannot afford their debt. They are decreasing shares, sure, but at what cost, right? At what cost? So at least when it comes to me, this is not a buy for me right now. If they were to bring up those assets minus liabilities, that'd be awesome. But that pretty much does it for this episode. Like if you like, comment, subscribe. It really does help out with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you will find exclusives as well. And in regards to YouTube and Rumble, I have a Let's Play channel called Fatal Plays. Also link in the description, where I'm currently playing through Pokemon Legends Arceus, so if you want to catch that, be sure to click on the link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.